You'll become very familiar with the financial reports we are going to discuss in this lesson. The first financial report we will talk about is a balance sheet. The purpose of a balance sheet is to look at the company's net worth at a single point in time. This is important to remember because most financial statements allow companies to look at their finances over a period of time rather than at a single point in time. Notice we can see the accounting equation parts in the balance sheet. We have our assets at the top, our liabilities second, and then equity at the bottom. One limitation to a balance sheet is the fact that assets are recorded at historical cost, which is the original cost the company acquired the asset at. The drawback to this is that the asset may be worth more money now than when it was originally purchased. This is common with land. If land was purchased in 1950 for $50,000 and is now worth $1 million, it would still be reported on the balance sheet at $50,000. The reason the historical cost principle is used is so that assets are not overstated, but with a significant increase in value over time, you can see how this could be a disadvantage to the company. The next financial report we will talk about is the statement of equity. Here's what one might look like. The purpose of a statement of equity is to show the changes in the owner's equity from the opening balance to the end of the accounting period balance. Every company requires this statement at the end of the fiscal year. This report shows detailed information on changes in equity assets that are not distinctly reported on any of the other financial statements. It is useful in identifying factors that cause changes in the owner's equity. This is an income statement. It summarizes the company's revenues, costs, and expenses over a given period. It also shows the company's net income. This statement conveys a company's profitability and can help the owner determine whether the business can generate a profit by looking at increasing their revenue and/or decreasing their costs. A disadvantage to an income statement is that it does not tell investors much about the company's past profitability. Its main focus is on the current profits or losses. The last financial report is the statement of cash flow. This is a simple example of what one looks like. It provides information about the movement of money in and out of the company during an accounting period. It helps investors and shareholders see and gain a better understanding about how much money a company is earning and spending. A common disadvantage to the statements of cash flow is the fact that cash spending can be delayed to increase the company's net cash inflow. While this can improve the immediate cash flow, it will affect the future cash flow. This report and the delaying of spending to improve appearances is one way your integrity and advice to your client may come into play. Be sure to offer an accurate picture to owners and investors.